Thanks for joining us for today's podcast from the Career Development Committee of the Market Technicians Association. We're joined by Ken Winans, who's enjoyed success in a number of areas, and we're going to try over the next few moments to see if we can tie all of those diverse endeavors together and learn more about Ken. Welcome, Ken, and thanks for joining us.
Well, thank you, Mike. It's a pleasure to be here.
Ken, could I bother you to just give us a few moments on your background and where you are in the investment community?
Sure. I am president and founder of Winans International Investment Management and Research. It's a firm that I founded back in, well, as I said, I founded it back in 1992. And basically, I had decided back then that after being an analyst for a number of years, being a broker, I decided I really wanted my freedom from the yoke of big Wall Street, and a lot of it was because of my beliefs as a technician. I felt that I was standing against the grain constantly against people who kept telling me that I should just buy and hold all the time. So it started there. It literally started with 7 clients, and right now, as of today, I think we have 140 clients globally.
And you have quite an interest in research also. Has that come from your technical background, or what drove the historical interest?
Well, you use the right word, Mike. It's history. I've always been a student of history, and when you couple that with an interest in finance and certainly in investments in general, it gives you an interesting willingness to want to go out there and do different research in areas that just for whatever reason haven't been covered. It's funny, though, when I go back and look at my original business model that I had for Winans International, it did not ever include at that point in time that I was going to have 2 patented indices and 3 books. That wasn't necessarily part of the original game plan. But as time went on, it very clearly showed that the research that we were doing for our clients could be of greater use. And interestingly enough, it actually is added to our marketing ability, our ability to draw assets. People today want to know that somebody is doing original research. So it does truly help. There's a synergy there.
Now, that's an interesting point. One of your indices is related to real estate. And if I'm not mistaken, you precede the CaseShiller index. Your index came out first.
Yes. Well, Dr. Shiller wrote about real estate in his book, Irrational Exuberance. But as far as having an indice that certainly went back further in time and was being tracked by the media, it's probably pretty close to around the same time. But one thing about the CaseShiller that most people, it's funny, even to this day I still have reporters ask me this, the CaseShiller always posts numbers that are 2 months behind. They always, in other words, they're going to show you recently what was going on in August, and our index shows what is happening in September. We post it much quicker, and obviously we go back much further in time.
And was that driven by your desire to apply technical analysis to real estate? What prompted you to develop that detailed of an index, which, for those who aren't familiar, goes back to almost 1800, if I'm not mistaken?
It goes back to 1830 on real estate, and it's funny people say there is actually good data back there, and believe it or not, there is. Our ancestors were very, very good at statisticians and mathematicians. But, Mike, it really came from I needed to know what's going on. We all know as technicians we have to determine trend. We have to come up with where are we in the current situation of markets. And I've been an investor of REITs in a long time. I have certainly other real estate-related investment areas as well. And I found that you just didn't have a good gauge of what was going on in real estate. And then coupling that with, as you started to want to put together historical consistencies. In other words, today, for instance, we remember what happened from 1965 to 1982 with the stock market. What did real estate do during that time? Did it have some bad hits? And the answer is it did. I needed to have an index that I could gauge historically how to look ahead, and that's where it has come in, and it certainly has fit the bill.
Now, that desire for a benchmark, so to speak, is probably what led you to create your other index, the one for preferred shares?
Yeah, absolutely. Just another example. Back in the early parts of this century, we were looking at a situation where for years and years and years we had just been buying listed bonds on the New York Stock Exchange, and suddenly that inventory was drying up, and we started buying more and more preferreds. And lo and behold, same problem. There's no benchmark. People would ask me, well, how have these things done historically? Couldn't tell them. Absolutely had no answer for them. And then it was coupled even worse then when Stefan Fitch, who's a senior writer at Forbes magazine, he was going to do a big spread on preferred stocks, and he asked me the same question. I said, Stefan, I have bad news for you. There is not a modern-day benchmark for preferred stocks, and he just couldn't believe it. So it was literally purely by coincidence that we had to go out there and build something. And it was ironic, Mike. I actually went back and pulled out. I have a collection of old books that were written back in the certainly the early parts of last century, going through the 1930s, and we had to pull back and look at how did these people look at benchmarks? What was the right way of doing it? So that's where the WIPSI came from, was the creation. Which, by the way, to build an index, people think a lot of times that you can just start and have it ready by tomorrow. It is months and months and months of trial and error. You have to constantly keep looking at it, because at the end of the day, it needs to be accurate. And you don't have that answer instantaneously.
Not only accurate, it has to reflect what's truly going on in the marketplace rather than just a mathematical artifact.
Absolutely. And I'll add another part to it. I've actually been very surprised, and I think we as technicians, we need to decide which side of the coin we fall on. It seems like the firms that we have long been entrusted with building benchmarks that are relevant, let's put it this way, I've lost my religion when it comes to looking at some of the big rating agencies and certainly some of the big research firms, because I look at some of the benchmarks that have been used that it looks like they were purely designed to slap an ETF off of, and they were not necessarily designed to be representative of a universe of investment. And I've raised this question quite a bit, and I'm really surprised that no one else has really picked up on it. But when you look at how some of these creations of major firms completely imploded in 2008, or we think of the tracking error problems, we think of all these things we keep hearing about, I believe it goes back to the methodology that a lot of these new indices were built upon. And I think anybody who uses ETFs needs to go back and ask that questions as well. I'm a purist. I believe indexes, whether you can run a product off it or not, is not the primary thing. It should be representative of what's going on in an investment medium.
Now, that's another interesting point you raised there, that an exchange-traded fund basically runs off of an index. You recently have created a mutual fund, and if I could switch gears, and it's so hard to get through in a short interview, probably half of what you're doing in life right now, but if I could leave the indexes for just a few moments, can you tell us about your mutual fund?
Well, it's actually a mutual fund company, Mike. My business partner and I decided that we have not been able to attract institutional assets, and it's just strictly because we set ourselves up originally as a separate managed account business, and a lot of the institutions say, hey, we love your research, we like what you do, but you're just not set up for us to give you any money. So we decided about a year and a half ago that we should throw our hat in the ring of having a fund. So we looked at whether or not we wanted to do a hedge fund or we wanted to do a mutual fund. And after looking at all of it and seeing what was going on in the hedge fund world, we elected to go ahead and bite the bullet and have a registered mutual fund. So we set up WI mutual funds with the idea that we could use a lot of our technical research for this fund as well as other funds going forward. We actually took over an existing fund that had some problems. We took it over, cleaned it up, and of course this has been a challenging year to be a long-short fund, but we think we fixed some of the issues that we had there. And in fact, I'll bring up tracking error problems with inverse ETFs certainly plagued us this year, and we learned from those mistakes as well. But we plan to have other funds. In fact, we're going to have a gold fund that is an actively managed gold fund that should be, we're going to strike the NAV on that, I believe, no later than November 9th. And then we're also looking at having some kind of a corporate income fund no later than Q1 next year. So we're moving ahead on this front, and I would encourage other technicians. The mutual fund industry is just ripe for us. Everybody wants to know that somebody is good at top-down analysis, and it seems like even though people are scared, they hear about how many mutual funds they are, and you just can't compete. I believe that there's still room for competition for good funds.
And so now you manage the separately managed accounts and the mutual funds.
That's correct. And I got to tell you, Mike, I'll say, people, you would think, well, it's two sides of the same coin. It is not. It's real interesting when you have to strike an NAV every single day on your performance. It is very, very different than an SMA side. We believe that we should be investment managers. As I tell people, I'm not a day trader. I'm an investment manager. But unfortunately, movements in NAV can cause drawdowns and certainly can cause inflows into your fund. So unfortunately, many people in the investment public who call themselves investors are in fact really trading.
And even though we say we're in it for the long term, you're forced to peek at it every day now, aren't you?
Absolutely. And the other thing you find too, there are errors in NAVs. I mean, just like we had the little flash crash this last March, we just had a situation not long ago with the NAV on our first fund that went way off the beaten path, and the firm that strikes the NAV said, oops, we made a mistake. But we can't get it reversed on the databases, so it's forever showing this wild one-day action that never really happened.
If you had made the same type of mistake and misreported something, do you think the SEC would care?
You know what? I'm constantly amazed at what gets overlooked by the governing agencies, and I just am left to believe that they are so overwhelmed right now, especially with the new regulation coming down, and probably the eventual regulation of all hedge funds. I think they're so overwhelmed that this is just a drop in the bucket. But Mike, I'll say this though. I think it should cause all of us to remember that you can, even in today's world, get bad data. And if you're not willing to roll up your sleeves and comb through your data, your databases, I believe it's an important part of being a technician. You do not have time to do it when the bullets are flying and the haze of gunfire and everything else that happens in bear markets. But I think a lot of us have gotten used to the idea, I don't want to do that. I just want to stare at indicators all day long. And I have news for you. You've got to go back and check the data.
Yeah, and the data is what the charts are based off of. We all claim to read charts, but bad data is going to lead us to a bad conclusion.
Mm-hmm, absolutely.
Now, you have a book coming out on preferreds. A lot of authors, when they issue a second edition, would simply update a few charts. You didn't do that at all, did you?
No, the best way I can describe it, it's like you start a home remodeling project and you say, well, we're just going to do this, we're just going to do that, and suddenly you've blown walls out of the house and you're adding rooms. And the world had changed so much because of what happened in 2008's financial hurricane that I found that what I had written about in the first book, Preferreds, although the research was very accurate and it served us very well navigating that tough period of time, but I mean the fact that the government was now one of the major investors in preferred stocks, I felt the need to have to cover all this and get into it. And then also, I was asked by many people who were not technicians, could you make the book a little more friendly for us? Could you make it where we can understand it past chapter 3? So I had that in mind as well.
And in fact, you do tell the story of the financial crisis. Maybe, in future years, it'll become one of the primary historical sources with that retelling.
Mike, it's funny. I'm also on the board of the Museum of American Finance back in Wall Street, and it's interesting because they have a whole new exhibit there on what happened with the whole debacle. And I was looking at this wonderful exhibit they have, but they don't have much talk about how the government picked this little obscure security to basically bail out Wall Street. So I hope you're right. I hope that the preferred stock role in the bailout's not forgotten about, because it is interesting that the government basically became an equity shareholder.
Yeah, Warren Buffett also used that vehicle, showing there's a degree of sophistication to it that I think the average person overlooks.
Absolutely. I think it shocked everybody when, instead of going in with some combination of fixed income and common equity, he said, I'll buy a preferred stock. And it was funny because I had an interesting vantage point during the 2007, 2008, 2009. I had a lot of calls from reporters because I was seen as one of the experts in preferred stocks. and you found a lot of people just, I guess the best way to put it was scrambling to get up to speed on what the security was, how should they view it, just really going back to ABCs of investing to try to figure it out. But now today we have it being so popular, people almost don't even want to look at bonds anymore, which I think is equally as bad. You got to be careful you don't fall in love with any kind of an investment. But it was an interesting time to be able to look at what happened to preferred stocks.
Now, Ken, I want to go back to something you said just a few moments ago, and I think it kind of summarizes your career. And I mean this in a complimentary way, but could you think of your career as like a remodel on a house that's gone horribly into overtime?
Mike, I think anybody in this business, you're constantly having to adjust. If you're an athlete, we all know the old adage: you never want to sit on the heels of your feet. You want to be on your toes all the time. You need to be in an athletic stance all the time. And I would say that's correct. I mean, Winans International has evolved in many ways beyond what I originally thought it would be or could be, and it's to take advantage of the opportunities that are actually in place today. But it is wild to think that, I'm one of these people that I enjoy all parts of our business. I enjoy the research. I enjoy being a money manager. I enjoy being a marketer, an author, a researcher, all that. But you've also got to make sure you don't go speeding off in so many different directions that you lose your effectiveness. There's got to be a synergy in everything you do in order to be successful in this industry. And at the end of the day, it's about making sure you make money for your clients. And you can't ever lose sight of that.
And you have grown almost an empire, basically starting from nothing, if I read everything correctly. You entered the business pretty much with no clients and no asset base.
That's 100% correct. In fact, I had the distinction of finishing my MBA December of 1987, and I had a job all lined up with E.F. Hutton back in New York. I was all ready to go back and live the analyst dream, and oops, here comes the crash. And I found myself trying to remind myself, how am I going to go explain to my father after finishing all my graduate studies that there was no work? So I do truly understand what the younger members of MTA are going through today. It can be scary, but if you're good at what you do and you really still love it after all we've gone through, it's worth sticking around. But no, you're right. I have, as many people do, you go through reinvention, but more important than reinvention, I actually view it as stretching yourself, looking for new ways that you can be productive and innovative.
And taking advantage of the business opportunity as it presents itself. So you do need to pay attention to everything in the business, and I think you're a great example of that. The indexes, separately managed accounts, mutual funds, a noted researcher, an author, and somehow you still have time for clients.
Well, remember, Mike, it takes a team. I wish I could say it's all me and it's me, but I'm also an employer. I have a full-time staff of 6 people. I just had a fellow MTA member just join Winans International from Europe. But you also have to have that team camaraderie that allows you to move ahead. But the other thing, real quick on this, is very important. As much as I like the equity markets, you can't fall in love with one area of investing. We've developed expertise in fixed income and preferreds and real estate. I think the firms that are going to survive today and the ones that I'm certainly seeing that are moving ahead and gathering assets are the ones that can easily have clients shift in different areas. The investment firms that have stayed equity only have suffered greatly through what's gone on recently because the world's changed. Clients don't want just stock-only portfolios anymore.
Yeah, I think that's great. The young technician needs to be able to adapt in order to survive in the future, just as you have in the past.
Absolutely. Well, Mike, real quick on this, and I think it's important to note, the number of MTAs out there that are writing, papers for Technically Speaking. They're writing papers for the Journal of Technical Analysis. They're doing their thesis. How many of them have actually ever done anything on bonds? I find if somebody asks me what's the next area that really needs to be gone back and looked at, fixed income is ripe for technical research. It's absolutely ripe for it right now. And I would encourage people, if you're looking for a place to go build your own indices and to make your own mark, Not to say that there's not more work to be done in stocks, but certainly the world is moving more and more toward fixed income, and I'd encourage us to do more research there.
And I'd like to wrap up by just adding that for those looking for research opportunities, I think kind of the sector idea applied to your real estate index is something that needs to be done. Somebody needs to take what you've done at the national level, start looking at it at the local level, start breaking it out into new home, existing homes. There's so much work to do with the seminal work you've done in real estate. And I'd urge anyone looking for a research topic to contact you to learn more about that. That's the advertisement I'm giving you, Ken. More work.
Well, thanks, Mike. And Mike, I agree with you. I'd like to think that I build a lot of just basic cement foundations that younger technicians can build off of.
Yeah, I think the work you do at the national level in real estate really does need to be applied at the local level. And for technicians listening, that's a quick and easy research project. It sounds like a quick and easy research project. I know from experience you're going to spend a lot of time getting nowhere with that until you find the data.
Oh.
Ken left out how difficult it really is to find that historic data.
Well, and not only that, but then you've got to be a decent mathematician to build an algorithm to get the pieces of data to work together. When I filed my patent on the Winans International Real Estate Index, which we also call the WIRE, there was more work the lawyer did on the algorithm that I designed than actually on the data itself. But you've got it. The beauty of it is, Mike, that if someone is willing to take the time to do that, it can yield revenue for you for a lifetime. People talk about, gosh, how do I get the press to call me? Build indices. The press will call you all the time. But you got to take the time to go extract the data, and you know what? It's not all on the internet. You got to go to the public libraries. You got to go dig the data out. You got to be a very good investigator, and a lot of people don't want to do that.
But for those that do, you've demonstrated this is a really viable career path, and I know we have to wrap up, but do you have any final words of encouragement for younger technicians?
Absolutely. You read in the press all the time about how Wall Street's laying off people, that, the industry's shrinking, that it's moving abroad. And the analogy I like to use is that, when the Roman Empire was decaying, not everybody lost out. The Frankish kings made out like a bandit. So I'd recommend that, technical analysis has never before had such a rise in prominence. And what I mean by that is more and more people are paying attention to it. So I would tell the technicians, hey, you can make money in this environment. You can succeed. Just don't listen to all the bad news. Find your niche and run with it. And I'd like to end on that note.
Well, thank you so much, Ken. And with that, we'll wrap it up. Thanks for listening, and we'll hopefully have another career development podcast for you shortly.